Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished fund manager Laurence Hulse of Dowgate. So welcome, Laurence.
Thanks, Paul, and good morning to all the listeners. Delighted to be back on again to talk about some stocks and hopefully have a bit of fun too.
Yeah, well, big congrats on last week's IPO of the Year award at the small cap ceremony for your Onward Opportunities Fund. But before we sort of run through your outlook for the rest of the year and beyond, I don't suppose you could quickly remind investors of what type of stocks you like.
So really, Paul, for us, it's all about change, whether that's personnel, strategic, operational. We look for change going on within a business, and often, sort of almost by default, that sort of change impacts the P&L. It's then our job as the fund management team to really unpick if we think that's going to be positive change, i.e. profits, and then maybe multiples applied to those profits increase, or it's bad change, as it can often be the case, and we sort of walk away and opt to not invest.
And how sort of active are you? Because let's just run an example. If you buy a company and you've seen positive change, and then halfway through it, you're monitoring it, and then you see negative change, in terms of steering that boat back onto that sort of positive course, how do you sort of as the captain of of the investment team, how do you sort of help that company get back on track?
You're right, Paul. We do take an owner's mindset when we invest. In fact, we quite like to think like private investors with our positions. We run quite a high conviction strategy. That means we do a lot of work and then a lot of monitoring on how are the profits of a business going to improve, and perhaps why is the multiple cheap, what's causing that, how ultimately might that improve and create value for our investment. And look, we're not there as activists. We don't seek to sort of rock up with boxing gloves and cause a fight. That's quite resource intensive. What we really like to do is leverage our experience and our network to sort of help guide a business and point them in the right direction, almost a bit of a wingman to the business, the company, the board. If things are sort of going wrong or badly, then perhaps that support might be a bit more involved and there might be a bit more heavy lifting to protect or recover value in an investment. But we are very much there to, our work is ongoing with these investments because we run quite long investment horizons, sort of 3 to 5 years.
Yeah. So you're not a Carl icon. You're more of a sort of an active business owner, sort of silent partner for the business.
Correct.
In terms of the sort of the portfolio, how many sort of stocks is a high conviction sort of play? How many stocks do you try and hold?
Tends to be between 15 and 25 with sort of 10 to 12 higher conviction core positions, and then another 10 to 12 in what we call the nursery, which is a developing idea or a more opportunistic nascent investment where perhaps doesn't warrant the level of conviction and work required to be a core position, but we can see really attractive opportunistic upside to complement those bigger, more heavy positions. And there's a couple of those we can talk about today, historic examples or new ones we've taken to bring that sort of mentality to life.
Okay, well, we'll go through those in a moment. And then just sort of finally, how's that sort of strategy played out? I guess because you got the IPO of the Year award, then it's gone pretty well since you floated on the LSE.
Yeah, we've been fortunate, Paul. We've worked hard, but it's gone to plan. It's not just about hard work. We have made some good investment decisions. The sort of 1 year numbers, the NAV is up about 25%, or year to date about 20, i.e. the past 6 months or so. That's positioned us really well in the sector amongst the likes of Aberforth, Rockwood in the kind of top 3. And that's a company we're very happy to keep and flattered by, really.
Yeah.
And it's all set for an H2 now where you've got a general election, a US election, and falling inflation in this country, as we've seen just this morning. So it's all to play for in H2.
Yeah, and what are your sort of first thoughts on the sort of like the general election? It does seem as though it's taken the wind out of the small cap sector over the last 2 or 3 weeks. So thanks, Rishi. But what's your sort of your view?
Yeah, look, we're not political commentators. I'm a great believer in not saying anything when you've got nothing to say, which I think is a pitfall of many other commentators. What I would just comment on, though, from a very much a sort of conjecture type mindset, I think near term, yeah, a bit of uncertainty around what does this mean for taxation, things like CGT, change. Is it going to be good or bad change? I suspect on a medium term basis, though, a bit of predictability is going to be good for business. It's A-level economics, isn't it? Markets, business, they love predictability, even if it's bad. One thing, no matter what political camp you're in, it's hard to argue against that the past 8 years have been pretty volatile, lots of change, various prime ministers. I think we've had 15 housing ministers in 8 years. If you're a house builder, how do you have a plan? And the house building is a long-term capital project. So I suspect that's going to be quite helpful on a medium-term basis. And if you're Keir Starmer, you probably save anything revolutionary to your second term. It's a bit of a tap-in now for him, and it's almost a case of let's not upset the apple cart. But we're very stock specific. We're looking for businesses that can cut their own jib, find their own way, and create value for their shareholders. If government's supportive, fantastic. That's a tailwind.
Yeah, I think you should get another award, understatement of the year there, for the amount of change we've had over the last. I think we've probably had about 6 prime ministers as well. Right, then let's move to the stocks. And I remember last time we spoke, probably about 6 or 7 months ago, Transense Technologies, which is a leader in sort of like wireless sensor technology. And I think you took us through, that's 3 divisions. But what's your sort of your latest view on this? The stock has done very well indeed.
Yeah, it's been a good early winner. It's a business that's been around for a long time. You'll recall when I spoke about it last time, had been a serial fundraiser, loss maker, and disappointer because of that. What we had identified about a year ago now was that the business had transformed under new management, and really what you were left with was startup upside in 2 of the technologies they have. And then a margin of safety in the third technology, which become effectively a royalty cash cow that underpinned the value of the business. And what I mean by that was the future royalties are worth about 12 to 18 million, depending on some performance metrics. The market cap was about 13 when we invested, and therefore that sort of was the margin of safety of buying into the stock. What's happened since has been really exciting. We have a very long-term view on this business. It's going to take 6-7 years for these 2 exciting technologies, one in torque, one in tire tread depth to mature. But when they do, they're super high margin. One's a 90% gross margin technology. The other's about 60-70. Right. So in summary, we think over 6 years, those 2 bits of kit can throw off turnover of about 9 to 10, a profit margin of about 40 to 50% off that because of those high gross margins. And because of the earnings quality, these bits of kit are often designed in, should command a very high kind of 20 plus multiple on that 4. Loose mass, 80 million. I think market cap today is around 20. So some good upsides so far. What's driven that? There was a really pretty exciting Airbus announcement a month or so ago, really proving out our thesis that these 2 bits of technology are real and can win some really big bits of work over the next 5 to 6 years. So good initial upside, lots more to go to over the long term. What we really like is the level of management buying, how consistent it's been. There was a purchase just this week. They know the business better than anyone. And there's been lots of exciting change in that business that they're recruiting quite a lot of extra salespeople. They're either doing that because they're stupid or they're quite high conviction that there's growth to go for. And it is a business that they publish quite a lot of content on LinkedIn. They've dramatically improved their marketing as part of this turnaround. And it's quite interesting monitoring some of the types of individuals that are liking some of these posts now. Their LinkedIn followers have doubled over the past 6 months. So it does feel like there's stuff going on in the business. They too won an award last week for their new tire products. So definitely want to keep tabs on, and management are quite good at providing video updates. So easy for investors to do their own work on.
Yeah, and I would say it still trades even after the sort of bounce in the shares, 12 times PE, got cash on the balance sheet. So it's not exactly expensive. If you have that EPS growth, that's for sure. The PEG ratio is going to be really low. What's the liquidity like in a business like this at sort of 20 million? I mean, is it possible to get, I'm guessing small chunks you can easily pick up, but a sizable position?
So we have built up a circa 10% position It did take us a number of months, sort of between about 80p and a pound, but it was long going. And look, at Dowgate, we're pretty lucky to have an internal dealing team that are very skilled at this sort of stuff. Two of the old Hargreave Hale dealers for Giles, so they were fantastic building the position. The company's currently buying back stock, and so that does take away some of the liquidity, but it also, the fact they are buying it back tells you there's stock to buy if you want it. So probably one to be patient on, but liquidity there, especially for the more individual investor.
Good. Okay, let's move to another one in the sort of industrial sector. We've got MPAC, and we talked about this as well, which is basically a high-speed packaging machine automation company. Main sort of like divisions are in healthcare and food and beverage. That sort of accounts, I think, for about 80% of the actual business. Being boosted, obviously, particularly in the States, reshoring, higher manufacturing, and sort of that whole automation. But they've also got an interesting new clean energy in sort of like EV battery manufacturing, putting package. Give us your latest view on this one. The shares have done terrifically for you, and I think they've got a bit of a rock star CEO as well.
Yeah, the CEO, we spent quite a lot of time referencing Adam. He used to work at JCB and Rolls-Royce before that, and the referencing was pretty stellar. And it was that really gave us the conviction to build quite a big position in the portfolio in MPAC. I walked listeners through last time around how the core business, there's quite a very credible, backable organic sales growth story. Turnover goes from about 100 to just over 200. And within that, we believe EBIT margins can recover from 5 to about 12. I think they've already got them to 9. So given that's a 5-year plan, they're making very good progress. And if they do that, you get a sort of EBIT number of about 24. And I think when we last spoke, I was putting that on a kind of 7 times target multiple, and that gave you a share price target of about £8.80. This is one of the few ones where we've actually had to kind of upgrade our ambitions for the stock post-investment. Usually we're quite miserable and grumpy and have a lower target than the brokers on multiple and things. But since we last spoke, a bit like Transense, there's been a fairly transformational sort of contract win announcement. When I walked listeners through the MPAC story last time, I talked about that core business and that being a really attractive investment versus the £2 price on the screen, kind of 4x. But there was this kind of optionality in electric vehicle batteries where I think we joked around how slightly bizarrely MPAC's legacy or history, they don't do this anymore, but it was in packaging cigarettes, and the sort of delicacy required for low margin, very, very fragile cigarettes is the same skills required to package highly volatile, highly valuable chemical batteries for electric vehicles. What's been really exciting is they have since announced the completion of the first trial line for Freya, which is a very large Nasdaq-listed battery producer working with Volkswagen and 24M. They've also announced Tartov, through their Agratas subsidiary, have also partnered up with MPAC. So all of a sudden, quite a few very large businesses are spotting MPAC have got this capability and sort of knocking on the door to work with them. The reason why this is quite important is twofold. Battery success will make the 24 million EBIT target, perhaps, too light by some way. And the reason for that is a typical order for MPAC in pharmaceuticals or food and beverage, where they do most of the work at the moment, is about £2-3 million unit size, whereas a battery line is more like 8 to 10. You don't have to win too many of those to make an impact on a £200 million pre-existing sales target. And we think, of course, that the structural growth and the level of IP capability that winning these battery orders implies probably means that the 7 times EBIT target I talked about earlier is a bit harsh too. So we're now sort of thinking MPAC is more of a 12 times EBIT business rather than 7, partly because of the emerging battery success. But what we've also come across, you talked earlier about how we stay engaged with the businesses and monitor them because we're active shareholders. We've noticed on Merger Market that a lot of peers of MPAC are being bought on 12 to 15 times EBITDA, and they don't have battery capability. So again, you can argue that 12 times EBIT is still conservative in that context. So we think there's plenty more to go for on this one over the next 3 to 5 years, despite the strong run it's had for the fund, onward opportunities, but also other shareholders that we sort of tipped it to last time and hopefully bought in with us.
Yeah. Well, if on a 12 times EBITDA multiple, and if you did 25 million of EBITDA, just to keep the maths simple, that's what, 300 million market cap with sort of like a balanced balance sheet. The market cap currently is what, just over 100 million. So
yeah,
there's a 3x there, that's for sure. Okay, let's move to another one, which we've got really interesting technology, Windward, which basically tech services, does AI sort of like almost an X-ray view, provides X-rays views to corporates and to oil services companies and governments of the maritime supply chain around the world. And as people, listeners will probably know, there's been a lot of sort of like, sanction busting with Iran and Russia, plus the problems with, out in the Middle East with sea freight having to go around the South Africa instead of through the Straits of Hormuz and stuff. What's your latest on this one? Because I think it also inked a deal with the London Stock Exchange as well to provide their sort of unique patented information into that.
Yeah, this is another one that's had some good announcements, momentum since we spoke about it on the podcast at Christmas, Paul. We talked at the beginning, didn't we, about how we look for change, and operational change is one of those. Well, Windward is building real contract momentum, and it's because of the quality of the offering. When we spoke about it on the previous podcast, we were a little bit gingerly on it because we were still finding our feet on it ourselves. We've actually upweighted this position quite significantly since we mentioned it at sort of 70, 80p on the last podcast. It's now a top 5 holding in the fund. And that is because it's arguably the highest quality business we own and one of the ones we're most excited about for the next year or two. The business has real IP, and you see that in the 80% plus gross margins. What they actually do is twofold. And in one side of the business, it's AI-driven insights into marine traffic, really for compliance tools. Now, we all know the kind of value compliance tools, compliance data sets can command at maturity. And they're working with some, you mentioned the LSE group they won. They also won Interpol quite recently, and we'll come back to that in a minute. So that's quite a good indicator on a few things. So really what the business does, it brings in lots of different verticals of data, computes them for clients, which is things like the US DOD, the US Coast Guard, Interpol, a number of anyone that wants to avoid breaching sanctions or monitor other people for breaching them. Very topical, as we know, sadly. The Windward technology can identify these misbehaviors and flag them and prevent breaches or flag breaches, depending on what the customers demand. The other side of the business, which is developed more recently using the original heritage of the business around sanctions compliance, is around supply chain insights. So they've used some of the same technology, but with some new applications and new data sets to really allow big blue chip customers, people like BHP Billiton, they've recently won, to very, very accurately and down to a granular level predict when their supply chains, how they're going to behave when containers are going to arrive, rather than the sort of slightly agnostic window you might get from the freighter themselves. Obviously, very relevant, very value add in an era of reshoring. That same theme as we like with MPAC. Supply chain complexity, things like Red Sea disruption. And because they have these two divisions in very, very thematic areas, sadly so, it's driving the business to grow at 30% per annum. Their last set of results are probably the best I've read in my 10 years on AIM in terms of momentum, quality of customer wins, the number of them, and the velocity it's happening at. And our investment thesis is that growth continues. We think it will continue partly with some quite exciting product rollouts, again, in the supply chain and logistics area, which Ami, the CEO, who is an award-winning entrepreneur, is very clear is an area of big growth for the business, and we think they're working on stuff over the summer to drive additional growth. This will be one of the very few small cap ways for investors to play AI, which we're seeing the way that's sort of commanding interest in the US. Hasn't quite happened in this country, but this is a genuine AI player, which you can buy on 2 times sales, I think 2.5 at the moment, growing very fast. These open source intelligence assets tend to get bought on between 5 to 10 times sales. So, even if the sales didn't grow, there's a lot of upside in the multiple. But we do think this business will grow at 20 to 30% per annum for the next 3 to 5 years. It will keep winning impressive customers because there's genuine IP here, and the value proposition to the customer is so strong. And most crucially, I think the current, not headwind to the stock, but perhaps the bear case would be it's not profitable or hasn't been. Well, we believe that's imminent. If you analyze the change in commentary between the full year results and the recent AGM statement, the business had been talking about exiting 2024 at break even. At the AGM in May, they talked about being break even within the year. So that's telling you, given this is a 99% contracted revenue business, that trading is strong and probably slightly ahead of where they expected. That's really relevant in the UK market being cash generative and break even, especially when, like Windward, you have a $17 million surplus cash balance on the balance sheet. The other potential bear case or challenge to the stock is it's a tech business. It's an Israeli tech business. Where's the investment going? We love that they don't capitalize development. It's all gone through the P&L. So that's a real break-even number when it happens this year. And we don't think, we only think high-quality tech businesses win customers like Interpol or have Lord Brown of BP on the board as chair of a $100 million business. So high quality, high growth, and one of the few ways listeners can play the sort of structural AI themes going on at the moment.
Yeah, no, I mean, just as an add to that one, I mean, I know the person at this London Stock Exchange who deals with Windward there for that service, and they love it. So, yeah.
Oh, wow, that's really helpful to know. Thank you.
Yeah. So they reckon it's a really quality service. Okay, good. Let's move to gaming. We've got Team 17, which again has been through the archetypal model where the P&L was moving south and now seems to have stabilized, and there's a bit of hope that it's going to start moving. It's basically a indie gaming developer, does its own games, small games, etc. I think about 35% of its revenue. The rest of it is developing games for third parties. What's your latest on this one? The stock has come a long way from its highs of 2021, but has bounced a bit from its lows sort of 12 months ago.
It was a bit of a darling stock over the years. One I never owned, being a sort of miserable value investor, but because of the hiccups of the past 24 months, we finally got a chance to own it at what really classed as deep value, which was kind of 6 times PE on a twice downgraded E number. Team 17 has a core stable of legacy, historic, own developed and third party sort of stabled games that we really like. Where the business had gone wrong, if you recall, they'd started to get a bit too excitable in the bubble of 2021, overinvested in what proved to be bad games. The new strategy under Frank Sanger, who's high quality chair, he's actually the chap that got Codemasters sold, and we'll come back to that in a minute. It's a simplification strategy, and I talked about simple change at the start and being a simple team. Strip back investment, run the core stable for cash, very selective new game development, but some, and we're fine with that. And that should drive a margin and multiple recovery in the business, which is starting to happen from where we invested at about £1.65 last year, or the turn of the year. There's a lot of interest in the sector. You've seen keywords go, a lot of previous ones have gone. This business, I think, is still on a kind of PE of 10. That is totally the wrong multiple for an indie game stable. If you look at the earnings forecast, we suspect, given they were sort of cut at the start of the year, and we've had one of the coldest, wettest springs and summers in memory,
yes,
we suspect there's probably upside risk in the earnings too. So that P of 10 might even be a lower number once the E is adjusted. So you've got good margin of safety in the cash generative legacy games, sensible chair and new CEO who were buying shares earlier this year. Multiple trough earnings. There's lots to like. And one of the more liquid names in the portfolio, to pick up on one of your comments earlier. So no issues getting hold of stock.
Yeah, good. And would it be impacted at all going forward by sort of regenerative AI with the likes of GitHub, basically potentially being used instead of third-party developers? Because obviously around about 2/3 of its revenues come from third-party titles.
It could, never say never. I think that was the sort of challenge thrown at Codemasters, and really why the shares got totally drilled earlier in the year, and then that's got to have been bought on a huge premium. I think it's quite easy to point out potential threats. If anything, it could be an opportunity for them to take out cost and lift up margins higher if they harness AI properly. But the business may not be around long enough to find out, because if it stays at 10 times PE, that they can make a lot of money just on the multiple arbitrage down here.
Yeah, no, I agree. And there's definitely, if somebody buys it, there'll be a lot of operating leverage they could get out in terms of just taking the gross margin. Okay, let's switch sectors. We've got automotive, CT Automotive, which does interiors for normal OEMs, car manufacturers, but also premium brands, things like, fascias and cup holders and arm wrap pads and stuff like that. So they do all the essentials which make or improve the quality of the interior for a particular car. It came in, was listed about 2 or 3 years ago, had a bit of a profit warning, got a problem. Now seems to have sort of like recovering well. What's your latest on this one? The automotive traditionally is a tough industry.
Yeah, so this is the first of the stocks we're talking about today that's in that nursery component of the portfolio. And that's because whilst we really like the return of the founder, the thesis, the business, frankly, the sector is always one that's been one to be wary of for investors over the years. So on those grounds, hard to go all in and make it a high conviction core position. But what we really do like, it was an unsuccessful float, and it was an unsuccessful float for 2 reasons. And this has typically been quite a good hunting ground for our strategy. The founder, Simon Phillips, who very, very capable entrepreneur, fantastic backstory. I mean, my colleague Jeremy McEwen, I think, did a podcast with him at some point. Yeah, this is a proper rags to riches, made his own way in the world entrepreneur. He stepped away to really, hopefully let the business run itself and enjoy semi-retirement. The management team he put in place didn't work. It was partly because market conditions got quite tough during the pandemic and the supply chain disruption afterwards. But really, it's become clear that this is a business that he knows how to run well, but it's quite hard for anyone else. So he's come back with a very clear margin recovery story, gross margins from kind of 15 to 30, simplistically. It's more like 19 to 33, but I'm just keeping it simple for the listeners. And that should take operating margins back from loss-making to the 5% they just announced up to kind of low teens. They're going to do that through a lot of cost takeout, increasing utilization in the New Mexico site, and there's strong evidence of that working already. As you'll have, they recently did a Investor Meet Company type webinar where listeners can hear more. But very clear margin recovery story that's currently on 6 times PE. Well, a 13% operating margin should be on more than 6 times PE, and we actually think that the management team seems, or certainly the returned founder Simon, comes across as being quite bullish around market recovery, but also maybe winning some new cars to be designed into. That can be quite attractive because once you're designed into a line, you're in for that model's 5-6 years, but also you've got a very high chance of going back in. They work with a real range from sort of Nissan to Lamborghini to Maserati. So they are best in class, high quality operator. So we see at least a 2x upside here on some initial cost takeout margin recovery, which makes the multiple wrong, and then perhaps some customer wins later in the year or even next year. and the founder's really aligned to sort this out because he owns 20% of the business.
And what do they have any pricing power in terms of the automotive sector? Because is it really a self-help sort of like get the supply chain and the production system sorted out rather than actually having any real, sort of like IPR there?
Bang on, self-help that they do through their sites in China, Mexico, and Turkey. They do seem to have a cost advantage over some of the other small operators in the sort of tier twos that are maybe one geography. Because they have three, they have this quite clever way of sort of matching the best cost base to each component and then bringing them all together. And that's what's allowed them to win work in the past, is they've been a sort of cost leader.
Yeah. Right. Okay, good. Well, let's go to house builders and infrastructure. It's very topical with the general election because we've had sort of like up and down reports from the house builders this year. Who had a good start with the spring selling season, which has been dampened by the general election, apparently, according to the RICS latest survey. But if Starmer does come in, he's saying he's going to bulldoze through all the planning permissions. So we've got a sort of like a positive, outlook. Let's just turn to the biggest house builder in Scotland, Springfield, which you own, does sort of private and affordable. Won a big contract with Barratt's, I believe, just recently. What's your latest on this? Still pretty cheap, actually, compared to net tangible book, I think.
Yeah, I mean, this was really a special situation with house building recovery as a cherry on the cake if it happens. We've had countless governments promise to sort out house building, and I'm slightly cynical it'll ever happen because if we build too many houses, then most people's primary asset, which is their home, is probably going to go down in value, which I think that creates a few headaches for the mortgage market and the banks. But that's for another podcast. Yeah. But back to the Springfield situation, special situation. So the business has the largest land bank with planning permission in Scotland, if not the UK. One of the biggest challenges around house building is getting planning permission. So that is a real strategic asset that's probably worth more than its carrying book value. We identified this. We saw how those assets could be disposed of to create value for shareholders. And that was really twofold. Initially, the business was overgeared, where they'd done some M&A at the top of the cycle in 2022, 2021, which created pressure on the share price. We encouraged the business alongside, I think, some other shareholders, in fairness, you've got this asset that's totally unrecognised in the market cap and the EV. Start selling some of it down because you'll be able to. And they've done 4 or 5 disposals now, all at a profit to book value, which has been taking the pressure off the balance sheet. I think net debt's fallen from about 90 to 41. That was a big outperformance of the forecast of net debt of 55. We expect that and encourage that to continue. And the most recent of those was the big deal with Barratt that you referenced. And that's allowed the business to undertake a really big, I think it's 3,000 homes project. Yeah. That's what's gone on. What do we expect to happen next? What do we hope to happen next? Well, the business still trades at a pretty material discount to book value. Book value, tangible NAV's about 130 a share.
Yeah.
The shares are 90 on the screen, having had a decent run, but still plenty to go. And most of the house builders are trading on kind of 1.2 times book value. So you can see a path to £1.50 if they keep doing these disposals, paying off debt and highlighting the balance sheet value, that how real that NAV is, and that maybe it should trade at a small premium like the other house builders. And then from there, we expect it, when this isn't one where we're going to sort of see the situation play out and exit. We actually see this as then becoming quite a nice little compounder into a moderate recovery in house building, especially in Scotland, where there's been some very specific issues, partly SNP driven, dare I say it, where perhaps a Labour government in both England and Scotland could unlock a bit of volume there and just see that compound nicely through the next house building cycle. Scotland's one of the most affordable places to buy a home in the UK, so we quite like that exposure.
Yeah. What in terms of their land bank, is it all sort of permitted or is it actually unconsented stuff? Because there's a big difference in terms of Starmer saying he's going to bulldoze a planning permission, but actually he's going to hold new planning permissions to capture for the council. To be, that's some of that uplift when you go from unpermitted to consented space.
So about from memory, I think it's 73% of the total land bank is fully planning permissioned, and
Okay,
so it's ready to go, and that's when they've been able to sell these assets quite quickly. And it doesn't take many more of them. It's just a really neat transfer of enterprise value to equity value, where the debt comes down, the market cap goes up, kind of thing.
Yeah. Good. Okay, let's move to another company in this sort of infrastructure sector. We've got Speedy Hire, which came out with results today. I think you talked about it as a recovery play. It does sort of like, tool hire for DIY enthusiasts, but also sort of, professionals and people like this. Competes against VP Group in the UK. Also, I think HSS. It's had a problems. It's been sort of like a bit accident prone of late, but they seem to have now got a grip about the actual business. What's your latest on how the turnaround's going? The market at the moment for sort of like, DIY repairs isn't booming, but if Starmer's right, then it may be in a sort of 12 months time.
It's definitely been accident prone, but fortunately the new chief exec, Dan Evans, is a sort of Speedy Hire lifer, so definitely has a hard hat on. I think he started off running one of the regional depots and has now ended up recently as chief exec. It's another one that's trading at discount to NAV, like Springfield. In this case, that's a discount to the value of the fleet. It's a fleet of kit which is mission critical to any expansion in construction activity in the UK. The PMIs have started to pick up in that sector, and we do think if any sector is going to win or be a net winner out of a Labour government, it's general construction, not just house building, more general. And Speedy Hire is a geared play on that. I'm glad you mentioned HSS, that they had not such a good announcement last week, a big contract loss.
Yeah.
I think it's been clarified this morning, but we believe pretty strongly Speedy Hire have won that very large contract. So a good indicator on their competitive position. There are three players: VP, HSS, Speedy Hire. They talk about this morning, some other material contract wins, things like the MOD, that should start to feed through to FY25, the year just started, and beyond. It is very operationally geared. That works both ways. It's why the shares have been so punished lately, already the past 3 or 4 years. But on the way up, could be some quite exciting asset-backed returns for listeners too.
Yeah, it comes down to asset utilization, return on capital employed, doesn't it? And at the moment, it's the bottom of the cycle. Okay, let's go to another company which you don't normally talk about. It is Aquis Exchange, which people know is a sort of like a micro cap, sort of like old LSE type model. It sort of like does exchange software for sort of like, that the other Aquis, the non-LSE exchange, Aquis, which does sort of like, semi-public, or they are public, I suppose, but they're all, sort of AIM companies, etc. But now was also selling its technology, licensing that out and starting to sell data as well. So it has a number of interesting strings to its bow, presumably high gross margins. But effectively, it hasn't really, it's always struggled in terms of getting properly appreciated. What's sort of your view on this one?
So it's another one of the sort of nursery holdings, and one that's actually performed really well from where we bought it at the start of the year, kind of 340, 350. The name's actually quite unhelpful. Everyone knows Aquis as a challenger, sort of, challenger stock exchange. Is there some upside in that business? Probably. It's been a very tough few years for small market cap floats, and I think they had one very recently. And it would be rational to expect volumes to pick up in that sort of thing. But actually, the exchange, the part that most investors know of best in the business, is actually the smallest and probably the least relevant to the upside that we think we've spotted. The bigger parts of the business are more interesting to us are the markets and technologies divisions, which really develop trading tools and exchange data for subscribers to the data. And that's where the high gross margins that you sort of flagged come from. And if they can continue to grow those divisions, we'll start to drop through to some pretty healthy bottom line margins, which will then start to make the current 15 times EBITDA multiple collapse quite quickly. We sort of bought lower than that as a flagged, but there's a key catalyst we believe coming up that should transform both the growth prospects of the business but also its pricing power. And that's this change to a consolidated tape of trading data across Europe and the UK. At the moment, people go to different exchanges for different pots of data. In the UK, the main one to go for is the LSE, obviously, is the main exchange. In a consolidated tape scenario, Aquis would be bundled in with the much bigger LSE data, and will get, therefore, almost kind of piggyback off the interest in LSE data and have much better pricing power, so an uplift further in gross margins, but also most likely a fairly significant increase in volume of subscriptions. So you get a kind of double kick of sales growth on improved gross margins that drop through, and because of the scale of Aquis as a group at the moment, pretty meaningful uplift in operating profits and margin. Slightly off-piece little investment we've made, hence being in the nursery rather than a core. But again, almost like Windward, a bit of a data asset in here, which over the long term, it will become a bit of an asset to cover if management do what they say they will do.
Yeah. What just take an example, one of their clients of a consolidated tape, that means that everybody gets everybody's data. Why would one of their clients go to them rather than the LSE, where they could get Aquis's data as a part of the consolidated tape?
Well, this is the whole point of the consolidation. So at the moment, you go to the independent providers, but under a consolidated tape, it's all bundled by the regulator together, and you have to just buy the consolidated tape, not sort of pot shots.
So why would they? But lots of people then selling that consolidated tape, won't they?
They will be, yeah, which Aquis will get a sort of cut or pass through.
I see. So it's sold by the regulator. Oh, got you. Okay, fine. Yeah. So effectively, you get a percentage of what you've given, and
it'll be a much bigger pot than Aquis currently gets exposed to at the moment.
Yeah, okay, understood now. Okay, I was just trying to get my head around that one. Okay, good. Financials. Let's move to spread bettors. We've got a couple of them: IG Group and CMC Group. You've had the latter going through the moon. And let's start with IG Group, because still very, very cheap. It's the number one spread bettor and CDF provider in the UK. Trades amazingly, as it always does, at about sort of like 8 or 9 times. Pays about 5 or 6% dividend yield. A bit of a cash monster, actually.
So I think you remember on the last podcast we provided listeners with a bit of a pair trade on Liontrust and Miton together.
Yes, I remember.
And that played out quite well for listeners and the fund. I think Miton rallied the best part of 40-50%, and Liontrust sort of similar numbers. And that's because they were sort of geared plays on UK equity, mispricing, and hopefully recovery, which has started to play out. This time around, we've got CMC Markets and IG Group for the listeners. We've got a similar kind of pair trade on. So we own both of the stocks, even though they're sort of competitors. And that's really because the theses are very similar. So why would you not diversify by owning two rather than one? IG Group is the cheaper of the two at the moment, and CMC Markets has had a really, really pronounced share price move, which we've profited materially from for our investors. We obviously anticipate something similar for IG Group. That's why we still own it. Really, the thesis comes down to twofold. Both businesses have been dramatically taking out cost after really bloating up in the kind of day trading retail investor boom of 2021 and lockdown, where those costs went up. Initially, that was fine because trading volumes were through the roof, and then they predictably, really post the start of the bear market, collapsed. The reason why CMC Markets has rallied so hard so far, one of the reasons is that cost takeout washing through and driving pretty dramatic upgrades in the business. We sort of model something similar happening in IG Group. I think they update in July from memory. And if they do, the sort of PE of 8 that IG Group on is wrong. CMC is currently on 15 now after shares more than doubling. Beyond that, though, it's not just self-help with these two. Trading volumes are on their floor in a similar way to how equity markets and flows are in the Liontrust Miton thesis. There are signs of that and volatility picking up. CMC Markets actually interestingly announced yesterday a partnership with Revolut. We really like that, because if you can get cost takeout and then turnover growth in both of these, they really could be quite quick returners, like CMC has already proved to be. They're both building up cash piles on the balance sheet as well, so you've got margin of safety. Are these 25, 30 times PE businesses? No, because of the lack of visibility. But if investors do start to believe they're going into a recovery scenario, they could well trade at 2020 plus for a while, pricing in that those EPS upgrades to come. CMC's already had some. We expect some from IG too for similar reasons. With CMC, we think earnings EPS in the medium to near term through cost takeout and some volume recovery can get to sort of 30, 35p, and you put those on kind of 15, maybe 20 times plus the cash. It makes the current share price of about £2.60 look opportunistic, despite the fact they've already doubled, and we've benefited from that in the fund. IG Group on 8 times. Well, if they can deliver earnings growth, and you've got a re-rating from 8 to 16, again, you can see how there's a 2x plus there as well. So, bit of a play on some of the volatility we're seeing in Europe, recovering interest in equity markets in the UK, and they're both very cheap businesses that are taking out cost.
Yeah, no, I agree. There definitely seem good opportunities. What about just a quick update on Liontrust? You talked about it in terms of it. Obviously, the asset managers really trough share prices at the moment, still, even after a slight sort of recovery. I guess the big question for investors is differentiation, whether these guys and then all the others, have they got something that is going to make them stand apart in terms of, winning new businesses, new mandates, and getting that, fund inflows?
Spot on. I mean, there's a price where you almost don't need to worry about that, which is where we bought Liontrust at kind of £5.50, £6. But I think to justify a proper sustained recovery above 10, 12, 14 and start commanding a multiple that implies real IP, you've got to exactly unpick that pull. And Liontrust has got some very clear branding. We see it as a market leader in sort of UK equity investments as a brand. We therefore believe that, I was tempted to say when, but it feels like if's more appropriate. If flows ever return to the UK market, they should be an early winner. Performance is good. They've got clear products. They've got liquid products, and they've been hiring a lot of sales team members at the moment. Again, one way you can sort of monitor LinkedIn activity a little bit and see people joining. So they'll probably have some good mark to market, and that's what's driven the shares up from 5.5 to 8.5. I think they're about 7.5 at the moment after the weakness of the past few weeks. But they're still on a 9-10% dividend yield, which now that there's been some mark to market in the AUM, that's pretty well covered. So on a yield compression basis alone, you can see quite a bit of upside in the stock. There is a wider strategic sort of conundrum for the sector. There's been M&A. There's been, you saw there was a kind of Artemis headline in the FT about Liontrust not so long ago. It's a sector with challenges. I'm an asset manager myself. I know them all too well. I suspect there has to be more M&A. Whether it's Liontrust, I don't know. It's a big old ticket that the market cap it is and the AUM it's got. But there's definitely all to play for in the sector, and it's very cheap and bombed out.
Yeah. I mean, I think in your situation, permanent capital wins, but sort of like the open-ended funds are a bit tougher space to a certain extent. Okay, now one sector that I wouldn't have expected to fall into the sort of the expertise of Mr. Hulse would be media, and it's National World, which is the business that I think it bought. Was it Johnson Press years ago, regional newspapers, etc. And surprisingly enough, actually, I've just seen this latest results. All the areas are doing well. Its digital's increasing. Its circulation, physical circulation, is actually increasing, and print advertising, which frankly just seems totally against the secular, sort of like thought or secular decline in sort of physical newspapers. What sort of piqued your interest here?
Sort of threefold. You don't have to know anything about media to know that 5 times PE, when the business has got a large cash pile, is probably cheap.
As long as the E's okay.
Yeah, and as you saw from the recent results, the E's more than okay. And that's before the impact of both the general election, which is the second thing that piqued our interest. Regional news tends to have a pickup in activity and readership around those kind of local constituency battles and headlines. But I think more structurally, because that's a bit of a one-off, What caught our eye was some of the commentary in the Future results a month or two ago around, and ITV actually, around sort of pickups in interest, if not volumes, in advertising revenues. And National World was really the only kind of small cap advertising play that hadn't moved like all the others were up 20, 30, 40% around that time. So we saw it as a bit of an opportunistic one. At the valuation it's at, with the cash pile it's got and the share register it's got, something's kind of got to give, we believe, as well. And there'll have to be some sort of catalyst to do something, because at this rate, it's just going to become a cash pile with some regional papers on the side. And we like catalysts, as you know. So that one, again, it's a nursery position. It's not a core, but we see upside in the multiple and the earnings.
Yeah. Good. Okay. Well, it's in that same media sector, but distributor. We've got Smith's News, which basically is the UK's largest distributor of physical newspapers to corner shops and to supermarket. I mean, again, very, very cheap, but I guess the secular decline in newspapers is what's going to hang over the whole sector.
Totally. And it's why, despite being on the screens I look at for as long as I can remember, never touched it, when actually that was the wrong thing to do, because the shares have more than doubled over the past 4 or 5 years and been paying out a handsome dividend too. What's changed? Back to that word change. Why have we got involved now? Well, during that 3 or 4 years we've tracked it, management have done actually a fantastic job of growing profits when revenues are falling, which is a slight sort of Houdini act, and always piques the interest if you've got a management team that can do that. So that's a sort of set the scene for interest. Further DD really uncovered that for the first time, the business might be able to sort of get escape velocity from the structural decline and grow again. And if it can grow again, the 2 times EBITDA, 25% free cash flow yield we bought it on is obviously totally wrong. Why do we think that can happen? What's going on? So the business has good management now, as I've just talked about. Once upon a time, it really didn't. A number of slightly horrific acquisitions were made using other people's money, i.e. debt, and the business became trapped with a pretty horrendous balance sheet. The hard graft of the current team has seen that paid off using organic earnings over the past 3 years. And that allowed the business options. And what I mean is they're throwing off now surplus cash because there's not much debt left to pay off. And it's about 25 million per annum in the context of a market cap of about 100. You can do some pretty meaningful M&A or investment with that amount of money. The good job they did with the debt also allowed the bank to get refi with them, gave them some headroom to do in growth capital if they want, but also near term, they removed the cap on the dividend. Now, even with the dividend cap, it was on a kind of 8% yield, but we think that can, on the current share price, go up to nearer 12 as the divvy is increased later in the year once this all washes through. So near term, fantastic sort of high yielder for clients with a good solid management team backing it. And medium to long term, this business could grow again. They've already had one successful example of this where they've started recycling for the same customers they deliver the newspapers to. So the van that drops off the Times, the Sun, the Daily Star, the Telegraph, the FT, whatever it may be, to all these news agents at the same stop, they then pick up all the waste paper and card, take it back to the depot, and it gets recycled. And that's growing quite fast, actually, that venture. And we think if they can find 4 or 5 things like this to do using existing infrastructure, you're going to get earnings growth and be paying 2.5 times EBITDA for it and getting a 10% dividend yield. That's quite an attractive story in an uncertain world, to have that kind of self-help, self-funded initiatives for the business. Shares have got off to a great start since we did invest. And I'm actually, over the summer, going to the depot at about 2 in the morning to see the business in action, because we do like to sort of smell and breathe the businesses we invest in. So yeah, one great one for income listeners.
Yeah. Well, that's probably why you haven't invested in sort of a Pennon where you have to go to their sewage farm at 2 a.m. That would be slightly more.
I've been to a toilet roll factory before.
Oh, yeah, okay, yeah, toilets like Acros, slightly less. Okay, well,
Yeah.
let's talk about fishing, all things Anglia Direct. Again, we spent a lot of time last time, but just your latest view on this one, because it's got a really good, strong UK business trying to branch out into Europe. Online seem to be going okay. Still, they seem to be picking up the gross margins, but 2% EBIT margin, still some way to go to get to sort of like a niche product you'd expect to generate.
Yeah, there is progress, but it's not good enough, and it's really what our whole thesis hangs on. This is a margin recovery or a really unlocking story, and if listeners will recall, the reasons why the margins are so low is because they've got a really good profitable UK business that we love, and I'll update on that in a minute. But they've been trying to grow in Europe, and it's losing money. And the losses in Europe are about 50% of the profits in the UK, and therefore you get really horrendous margin dilution that at the group level makes it look like a really rubbish, low margin, low ROCE business. And that's actually doing the new management team a disservice, because they're doing a fantastic job with the UK business. A few nuggets. My AD, the membership app they launched is now, I think, 300,000 subscribers.
Yeah.
That's a really impressive take up for what was a new product 18 months ago. They've accelerated store rollout in the UK. Historically, they were doing kind of 2 or 3. They're now talking the Retail Gazette and other publications of kind of 5 to 10. Faster growth. We like that. And actually, most excitingly, in the recent results, there was a suggestion that they are in sort of negotiations with a national UK retailer to have a kind of concessions type setup where Angling Direct takes a chunk of this existing store estate, and it's a fast track to grow more sites for Angling Direct. We're really excited to see what that is. It looks like it could be quite imminent from some of the language used in the results. So they're doing a good job, but it's not coming through in the margin. And it's really, I said at the beginning, we're simple, we like change. And the best way to analogize Angling Direct as an investment is as if we're fishermen. There's 2 lakes, Lake UK, Lake Europe. Lake UK, it's an all right sized lake. UK is one of the leading angling markets in the world. Angling Direct have the best berth around the lake. They've got the largest store estate and market share. They've been catching fish there for 20 years, i.e. making money. Fishing is a game of probability, a bit like investment. So Lake UK sounds like a great place to fish. In fact, we're saying to the business, put some more rods out in a second berth, because all the other fishermen are starting to pack up and leave because you're catching all the fish. That's a fantastic competitive dynamic for improving the margins you talked about earlier in the call, Paul. There's then this other lake, Europe. It's admittedly probably 3 times the size of Lake UK, and that's why the guys have tried to go and fish there. The trouble is, because it's larger, there's way more berths around the lake, and they've only just got there, so they don't have the best one. And what I mean by that is they only have 1 store in Europe. They've not been catching fish, i.e. they've been losing money. And actually, we've worked out the only way to see if you can catch fish is to buy loads more rods and kit and lures and have a go. If it doesn't work, that's a pretty expensive mistake and a risk we don't need to take, because we've got fantastic growth and profitability here in the UK. So we are, as you'd expect, behind the scenes pushing for that. What did the most recent results show? A fantastic UK business and a European business they didn't talk about much, and it is struggling despite real hard work of the team. And it's commendable what they're trying to do, because we'd love to be wrong. If they could crack Europe, it's fantastic. We just don't subscribe to that view, and it's one to keep an eye on, because pulling out of the European lake and just fishing more in the UK, you can almost double EBITDA pretty instantly by removing those losses. So that's quite a nice thesis on a business that's on a low single-digit multiple.
Yeah, I would agree. I think it's also a good sort of principle for investors, is such that when you look at companies who are trying to expand into into, you know, adjacent markets or overseas markets or whatever. Really question the buy or the build strategy, because logically you'd buy into Germany rather than organically grow it, because it's going to take too long, going to cost you too much, and you're going to be picked off by competitors. The only way to get there and not create capacity and unsettle the local market is to buy a brand, I would say. I mean, I've seen it too often.
Yeah, I think I used the word miserable a couple of times on the call. We just like simple.
Join the club.
And the reason why Angling Direct's the second largest weighting in the fund is because it's quite, it may not be the highest return multiple target we've got, but it's quite hard to lose money on this one.
Yeah.
Half the market cap is cash.
Yeah.
Either the UK, either they close Europe and go all in on the UK. Overnight, that kind of doubles profitability. That'll see the shares go up. Or they do, despite our instincts, make Europe work quite quickly. And the shares probably go up even more because it's much higher growth. Yeah. So you're quite well underpinned with a margin of safety, and you've got dual optionality on upside strategically.
Good. Okay, well, let's move to the very last one. It's Vianet, which has been around for as long as I've been professionally investing, 25 years. It used to be the old brew lines.
Brew lines.
I know, yeah. And machine-to-machine communications. They used to monitor beer flow. Well, they still do in pubs in the UK. Very highly profitable business. And then they bought Vianet, a Scottish business, back in, I think it was 2006, 2007, which gave them that M2M technology for vending machines. But the business actually now is starting to perform after such a long time. Interesting. What's your sort of your view on this one, and why is it underlined? Why is it changing now after such a long period?
Well, I think we all like monitoring the flow of beer in various ways, Paul. But Vianet was always one I quite like to track as an analyst, because the site visits were usually quite good. But no, you're right. What we've noticed more recently, again, I've tracked it for 9 years. Sounds like you tracked it for even longer. Vianet is becoming quite an interesting little strategic asset, and that is because the business has finally kind of worked out what its value proposition is for two sets of customers. And it really is around automation and telematics on the point of sale in two environments. One is what I call entertainment hospitality, historically pubs. But interestingly, for the first time in their results slide deck, which I think came up last week or the week before, they talk about being on trial at 2 stadiums. Yeah, that's just in the deck. I'm not sort of revealing any secret source. The trouble with brew lines was it was always a cash generative business, but it was in structural decline because of pubs. Well, that's changing because they're starting to win work in, or certainly trials in, things like stadiums, which entertainment venues are a growth area. Yeah. And I'll come back to that in a minute. The other point of sale where they really are making headway is in vending. And vending, a bit like MPAC and a couple of other stocks in the portfolio, is a play on a mix of labour shortages or labour cost. It's a great way for catering businesses, other retail vendors. They recently won a big deal with Wilcomatic, which is a kind of car wash business in the US. It's a way to reduce your labour costs by having a tap machine linked via 4 or 3G or 5G to the cloud. And it allows people to sell their product to consumers without having a staff member. Very clear structural growth there. What's really lit the touch paper under the business, a bit like CT Automotive, is the return of the founder, in this case, Jim Dixon, who again owns about 20% of the business, so clearly cares and wants to maximize value. He came back during the pandemic when the business really hit a rocky patch. And his impact has been, transformational in terms of organic growth prospects and then profitability and margin and what that's done to the balance sheet. So at the top line, you've got really the most bullish I've ever seen the business about pipeline in both divisions in the 10 years I've been tracking it. And yeah, go and look at the slide deck they put up on the website. I've never seen, or rarely have I seen, trial, assessment, those kind of adjectives used on the pipeline slide for some time. So the business is clearly having success in both the US, but also in the UK and Europe. So growth is there. That's then dropping through at the bottom line through a mix of gross margins improvement. I think they're now up to 67%, and we think they should get above 70%. And that's dropping through to operational gearing because the business is growing from a small scale, and that's been allowing them to pay off debt. Because the business is involved in point of sale, that's quite a lucrative, well, it is a lucrative part of the value chain. And Vianet is getting in kind of basically increasingly mission critical to some quite big customers or other suppliers in that payment space, their own offering. And we think ultimately this will make the business a strategic asset that is a kind of bite-sized deal that someone can fold in and make part of their offering and take out quite a lot of cost synergies, because Vianet's a kind of £30 million business where there's probably £1 million of costs you can take out just from it not being a public company with its own independent management. And all of this you can buy on 6.5 times EBITDA. It's 80% odd recurring revenue, 70% gross margin. Looks like a really healthy pipeline with good returning management. I'd say it's for us, that is at 6.5 times value. We've bought it between 4 and 7 times EBITDA because we think 10 plus is the right multiple. But to finish on a slightly sort of warm-hearted note, it's nice to see a business that's kind of struggled for a long time.
25 years.
Coming good, a bit like Transense earlier on. And it shows really the power of the right management. And I think that's something we've talked about before. How do you judge it? How do you back it? And it's quite hard to quantify, but when you get it right, it can have fantastic outcomes for shareholders and other stakeholders, employees in the business, board members. So we that business, really good set of results last week. Go and read them. Business that's changing for the good.
Patience equals profits, doesn't it? In terms of just the USPs, what are their sort of unique sort of, what do they bring to the game other than existing sort of technology? I'm just trying to get my head around in terms of, things like M2M technologies been around for ages. And it's sort of like I know they make very good gross margins, but a lot of that comes through for how you account for it.
So you've caught me off guard here. There is in the slide deck, they've partnered up with an existing US business that has a point of sale system whose name escapes me on the call, but that partnership seems to be going quite well and opening up doors for Vianet over there in terms of sort of customer introductions and becoming part of a wider offering to customers beyond just the sort of tap and vend. You can see how, I think they even reference in the slide deck, some of those trials we talked about are over there. And Walkomatic, the car wash business they recently won, I think that's 750 sites in the US. So they've made a beachhead and they seem to be now stepping in.
I'll have a look at the presentation. Okay, cool. All right. Well, thanks very much, Laurence. Terrific insights into all those stocks. And if somebody wants to invest in the ONWD Opportunity Fund, I guess that's pretty easy. You just it's a stock, isn't it, on the listed?
Yeah, it's a listed business where our balance sheet or our assets are really the portfolio plus cash, and investors can buy or sell shares in that on the London market. And it's really as simple as that.
Yeah. Well, brilliant. Well, thanks very much again. Massive congrats on last week's award. You've certainly set the bar high there. So like 12% plus 20% plus returns this year and over the last 12 months, plus an award. So we'll be expecting even greater things in 12 months' time. So thanks again, Laurence, and look forward to speaking in 6 months.
You too, Paul. Thanks very much, everyone, for listening.